Without further ado, I would like to introduce our esteemed speaker for tonight's session, Alexander Levy. Alexander is a partner at Hauser Henry and Ceron LLP and has been with the firm for over 7 years. He is focused on general corporate and commercial law with a special interest in mergers, acquisitions, corporate governance, and succession planning. Alexander regularly advises both purchasers and vendors of multi-million-dollar mid-market private companies across various industries. He also routinely advises companies on employment matters and works with individuals on estate planning. In addition, Alex specializes in setting up and facilitating the growth of startups and early-stage ventures, and is a patron of the startup ecosystem, especially for Wise Space Ventures. Alex, we're so lucky to have you here to facilitate this workshop, and I welcome you to begin the session.
Well, thanks, Selena. Thank you very much for those kind words, and thank you for agreeing to manage the slides in advance. So I've given this presentation a few times and hope to spice it up with a few examples, but good to know you all have a mandatory 1 hour with me, so I'll try and fill as much information as I can into this session. So without further ado, Lena, I think we'll just get right into it. There's a few agenda items. It's roughly going to talk about some business structures, it's really going to focus on corporations, so I'll caveat that. So we'll talk about the positives and benefits and some of the things to watch out for with incorporating a company. Then I tried to pick topics that I think, well, that always come up in dealing with clients at the founder stage or startup stage, but really it applies for every stage or size of company. So we'll get into employees and contractors and the ins and outs of those, hopefully from your vantage point. We'll talk about, well, actually, we're not going to talk so much about intellectual property, but that's for your benefit because I'm not an intellectual property expert. But what we are going to talk about is CASL, the Canadian anti-spam legislation, and we'll finish it off with talking about unanimous shareholders agreements and employee stock option plans. And as we'll see there, the two are sort of together if you're leaning towards that direction. So first things first is business structures. And I wanted to start here because I thought it'd be helpful to provide a brief overview of the three main business structures that are available, or that you might reasonably consider when starting a business. And these options, as you can see, are sole proprietorships, partnerships, and corporations. And undoubtedly, you've probably heard of these as well, and there's a lot of material out there that'll explain the advantages and disadvantages of each. And a summary probably not too different than these slides. But like most things, what is going to be best comes down to timing and has to be tailored to your needs. So this presentation will focus almost exclusively on corporations, as it tends to be the dominant choice. But before that, we can quickly start with sole proprietorships on the next slide. So a sole proprietorship is what we often think of at an early stage, although it really doesn't have to be. But typically someone's had an idea, they've acted on it, and they're starting to generate expenses or revenues in pursuit of this idea. It's pretty simple to do, typically just a business name registration, if that's the route. And you most often could recognize a sole proprietor if you get an invoice from a company, or well, it's actually not a company, from a business, and you see no Inc. Corp. Limited LTD or anything on the signature line. It's a bit of a dead giveaway. You're not dealing with a company in that case, despite appearances, you're dealing really with an individual. As a little side note, this presentation will be full of tangents. If you're ever operating as a corporate entity and you are signing off on your contracts and you're not putting LTD or Corp or your full name, you could actually, well, in rare circumstances, because people tend to do it, but that's part of what gives you your protection of being a company, because that's you saying to the other party at large that you are dealing with a corporate entity. So if you're not signing your contracts like with the full name and you actually are a corporate entity, I would highly recommend start doing so. But that's a little side note, because for sole proprietors, one of the main features is there is no corporate shield. Contracts, although perhaps maybe signed under that registered business name, is a personal obligation. It's one of the major factors of being a sole proprietor. in the profits and more importantly, I suppose, the losses from that business venture are flowing directly to the sole proprietor. So for this reason, it can be actually pretty attractive. But the main downside really being that there's no limited liability. It's also hard to raise capital as a sole proprietor if you really think about it. When you're a corporate entity or a partnership or something like that, there's actually something to invest into. As a sole proprietor, it's really just this business, and the entity is the individual behind it. So for that reason, its growth potential is probably quite limited. And in any ways, for liability reasons, you'd probably move on to a corporation at a certain point in time. And we could talk about that if there's any questions on that. As for partnerships, partnerships can be very interesting. So like a sole proprietorship, a main benefit of a partnership is the tax treatment with income and losses flowing directly through to partners. That can be very attractive for certain business types. You will commonly see real estate joint ventures structured as a partnership, albeit a specialized sort of partnership, a limited partnership to capitalize on tax treatment and some limited liability protection. However, we're also not tax experts, so I really not going to get into intellectual property, not going to get too much into tax. I would be doing us all a disservice. I would say that partnerships, how I'm going to talk about them, are easier to form than corporations. If you're going to put together a sophisticated partnership, it can actually be quite complex. You'd have a formal agreement. It'd be much like a shareholders agreement, at least the topics you consider. But the reason I say they're easier to form, I'm thinking about them more from the early stage. So you can inadvertently create a partnership by registering a business name and ticking off the box partnership. You can also form them by accident. So it's not like you've formally gone out and filed articles of incorporation or anything like that. And this can be problematic. And this stuff isn't to feel bad about it. It happens all the time, and it's by accident with good intentions. But people have gone out, they've ticked the box partnership. Someone registered the business name, and this stuff only happens when the relationship breaks down. So it's just something to watch out for by inadvertently ticking that partnership box when registering the business name. Or what I mean by accident is if you have two partners going out and describing themselves as such to third parties. I think we all know what people mean. That's your business partner, but you could also take that to mean, hey, that's his partner, that's her partner. And the problem with doing that, again, somewhat extreme example, but just a little caution to the wind, not to be so freely with the term partners when conducting your business, is partners can bind other partners. So if you're really loose and free with calling yourself a partnership, the law will say that, oh, well, you are a partnership. That's how you hold yourself out. That's how you describe yourself. And all of a sudden you are bound into situations that you never intended to do so. So there's a lot more to partnerships. It can be a complex sort of structure and very useful, but it's really not going to be the focus of today's discussion. So with that all being said, that leaves us with our corporations on the next slide. And corporations are, by and large, the easiest entity in which to raise capital, number one, that most commonly thought of anyways. And from a fundamental level, it's because corporations are this separate legal entity. You can create and sell various types of share classes. It's easy to have wrap your head around the concept, and investors really have a readily identifiable way to share in the growth of the company. And that's all very attractive. Another positive is because the corporation is a separate legal entity. If a shareholder dies, it doesn't mean the corporation is over. It carries on. The corporation, for better or for worse, it's also known to shield its investors and its directors from a significant amount of liability, perhaps one of the main features why people do this in the first place. So shareholders of a corporate entity, their exposure and liability is really limited to losing their investment. And that's a really attractive feature. However, a common question we're asked, and I don't know who this might apply to, so it's a bit of something to ponder if this ever comes into your sphere, is what are directors of a company liable for? And this is a really complex question. So I'll just raise some key points to consider. My only aim being to maybe think twice about being a director of a company you're not familiar with. Or if you are a director, some things to take into consideration and how you should perhaps items you should think about or how you should conduct yourself. Some of the things that a directors could be liable for, and you could unpack each one of these. You could be liable for unpaid taxes of the company. Now, which taxes depends on the legislation, but that's definitely out there. Directors can also be liable for unpaid wages up to a maximum of 6 months, so employee wages, and that's in Ontario. If you're in real estate, there's a lot of environmental liability. So I'm probably, my head's thinking more commercial real estate in this context, but I just mentioned this one because I've listened to enough environmental lawyers speak to be forever afraid of blindly ever volunteering to be a director or officer of a company that holds real estate investments. But it gives you the idea of the scope and breadth of what exactly you're signing up for and why you might not do so freely. But the big item for directors is that they have fiduciary duties to essentially serve in the best interest of the corporation and do so honestly and in good faith. And the truth be told, most of the time, directors are not going to be held personally responsible for the actions of the company. But this is for a couple of reasons. One is usually you're in and out of the company perhaps before things got that bad, or the company had assets on hand to satisfy any claims. So that's the good one. But the way you personally protect yourself as a director is you are held to a standard. Essentially, again, I'm paraphrasing a giant legal theory in a sentence, but it's more or less true. The standard of a reasonable person in comparable circumstances. So that means you can't bury your head in the sand. You can't just say, well, all this bad stuff happened and I had no idea. I just don't attend meetings. I don't show up. Well, you just buried your head in the sand and pretended nothing was wrong. You will not be accorded any deference by the courts if those are your actions. How you do avail yourself of those sorts of protections is attending meetings, is taking steps to actually understand the company. Again, I'm not suggesting you have to examine every book, but you have to be a reasonable person in those circumstances, which is a lot of the reasons why companies hire experts. You hire your accountant to do your taxes. There you just availed yourself of being a reasonable person to get an expert to help you with that. You hired a lawyer to advise you on X, Y, or Z. So if you take anything from this and you're signing up to be a director, or you are a director of your company, it's not to scare you off. It's more to inform you of what you can do and should be doing, and be wary of being blind as to the goings on at a company. I've also got in this slide, in the not so good column, the regulatory environment of corporations in their maintenance costs. I don't know how I feel about that necessarily in that column, because it is true that corporations are a little more costly to maintain and there's a bit more legislation to follow. But I do think it is a little overblown somewhat of what the requirements are. If I created a company tomorrow, my only real obligation is to file tax returns every year and submit an annual file. On the back end, yes, there's a corporate maintenance, maintaining your corporate records in a prudent manner, and you should. I'll tell you, a lot of people don't, and that's a problem by itself, but your actual costs are not that much on a year-to-year basis. So I wouldn't worry about ongoing maintenance so much as a reason to not incorporate. But I guess where I'm going with this is I don't think those costs should scare you. And I'm not saying, oh, just sign up and please give me a call after the presentation. I would just say, just wait for the timing is right, where you think you either need liability protection, or it becomes a little more tax efficient, or a better organized, or you want to raise money, and pick your moment. But don't necessarily be spooked by the cost of getting it all set up. And I know there's a million online platforms out there that can help facilitate that these days. And I'm happy to give my thoughts on those too, because I do think there's some good ones, especially recently. So if you don't mind, Lena, just the next slide. I wanted to talk about the jurisdiction of incorporation, because this comes up, and rightfully so, almost every time. And the question we're most often asked is whether to incorporate at the provincial level, so an Ontario governed organization, or federally. And practically speaking, I am struggling to find almost any difference of meaningful substance in the difference between the two. I think there's a misconception that goes around thinking that if you incorporate federally, that you think you're already operating on a national level and it's a little more prestigious, greater importance. But it's not really the case. I've honestly never seen that factor into any business decision whatsoever. Now, keep in mind, my clients are mostly privately owned companies, usually a relatively small group of owners or 20 or less privately owned companies. So in my experience, there's literally no difference between federal and Ontario and what your ongoing requirements are going to be. The acts are largely mirrored off one another, just the section references might be different. One thing federal companies do get that starts you off a bit ahead, if that's the way you want to phrase it, is they get a little more name protection nationwide, because you're going to be running your name search at the national level. In Ontario-based companies are running at the provincial level. I don't see that as a big deal. I've never really seen that be the make or break decision on which one to do. What is a make or break decision, though, this is the one difference, is there's a residency requirement for a federally incorporated company. So many provinces, as well as federally regulated companies, at least 25% of their directors have to be resident Canadians. The only provinces that don't have that requirement are BC, New Brunswick, and quite recently Ontario, which is great news. So if you anticipate that over 75% of your board, assuming 4 or more directors, are going to be non-residents, if you only have 1 or 2, that requirement actually spikes up. It's probably best to incorporate in Ontario, BC, or New Brunswick. So I just wanted to dispel a few of those misconceptions, and a lot of foreign companies will set up their operations. So the key thing to also note before I leave this slide is that even if you incorporate federally, you still have to register to do business in every province in which you're conducting your operations. Now, we could unpack what it means to conduct your operations, but it's not a shortcut to go national and think you're free to operate in every single province, where maybe that's a benefit of being in Ontario. You incorporate Ontario, you're already good to go. No further registration required for Ontario. If you want to do something in New Brunswick, you'd have to register in New Brunswick for that purpose. So in the next slide, talk a little bit about why to incorporate, and I've covered a fair amount of those reasons, so I just want to point out a few things. One is it is quick and easy. A lot of people do it with a few clicks of the button. I have a few cautions against that in future slides that'll come up, but it should be a straightforward process at the early stages. And the other part that I was dancing around a little bit earlier is the tax considerations. So the main thing about corporate entities are the liability protection and special tax treatment are 2 biggies, and raising money is a little bit easier through the corporate entity. So the corporate tax rates often make headlines in the news. Corporations benefit from small business tax deductions, and their profits are taxed in the hands of the corporate entity, which are typically, hopefully, going to be at much lower rates than perhaps an individual's tax rate. So what this does is it allows the corporation to accumulate wealth more quickly, enabling it to reinvest that money because it hasn't been taxed as heavily. So if you don't, I guess we're talking about startups here. So if you're finally generating more money than you need to live and you have excess cash, leaving it in the company could actually be a prudent move than even taking it out and putting it in an RSP. Don't take that as gospel. You'd have to run the numbers. But you can see how a corporation's profits taxed at a much lower rate just allows you to build wealth within the corporate entity that much quicker. And it's a very powerful tool, especially for future tax planning and other side investments. That's honestly one of the key advantages that we deal with a lot with successful business owners. The other really neat thing about corporations, and this is why you have to love tax accountants and tax lawyers, they find all the ways to do this, but there's a once in a lifetime, every Canadian has a lifetime capital gains exemption. So when you start your company, your shares are essentially worthless. not in a disrespectful way, but the company just started. There's nothing in it. So the shares are worth literally whatever you decided to pay for them. Could be 1 million shares for $1 or $1 for 1 million shares, something like that. So if your business goes from $1 and you sell it for $1 million and you're selling your shares, the capital gains exemption maximum right now is 900 some odd thousand. You will get that tax free. So it's a huge carrot for business owners that are ultimately looking to sell and become rich, which is nearly everybody. And it can get even better for business owners, because with the proper tax planning in advance, which is well beyond the scope of where we want to go, but there's a lot you can do to allow your family to benefit and participate in nieces and nephews. And maybe that's a discussion for society at large if we really want that, but it's there and it's extremely common, and it's just something to keep in the back of your head as the powers of being a corporate entity and having the right advisors in place. So that being said, I'd like to point out on the next slide some of the mistakes to avoid. I will admit, I think the tool out there that I see most often is people using Owner. Now, I never use Owner, first of all. I suppose my competition. So, but I think they probably got it all figured out. So some of these would fall a little bit by the wayside, but I'll caution that. But a lot of the mistakes we see, it happens far more often than you might think. It's quite typical that we might be approached by a client who's now in a dispute with their former business partner. Well, they're not former because they're tied at the hip with the corporation. But they're in a dispute, but no shares were ever actually formally issued. It really does happen a lot. And if you think about it, it's just because you incorporated a company, but you never issued the shares. And that could become a problem, especially when people have already put money into the business, but you never put down on paper who owns what percentage. So it sounds really easy, but it gets very expensive to untangle that, to really determine who should own what, and it gets really messy. So that's the first thing. The other thing is properly describing share attributes. We get a lot of articles of incorporation where we're tagged in after the fact that might have multiple share classes, but the share classes and the rights attributed to those shares don't properly set out what you need to set out, which I'll just give you the ballpark of what share classes typically address. There are voting rights. Who's entitled to dividends? Is there a priority? Can you declare dividends on your Class A commons versus your Class B commons? And in which shares are actually sharing in the future growth of the company? It sounds like a simple concept, and quite frankly, it doesn't read the way you think it might read in common sense. But I would say for people incorporating companies that want a little bit of advice and someone to walk them through not making a mistake, that's probably where the owners of the world, those online things, fall a little flat. Now, if you just want to get a company off and running and it's just you, and it's just a set of common shares, no problem. It's just when you have questions about the complexity, or you're thinking about issuing shares to employees or something like that, or you want to add a business partner, that's a bit different than just you and yourself now. So I think that's an issue. Also, sort of a neat little side note is the private issuer exemption, and that requires a little bit of explaining. We have securities laws and we have stock markets, which are highly regulated. Well, a lot of the same regulations pertain to privately owned companies. Just as a caution, you cannot go out and freely sell your shares and distribute them to just anybody. There's all sorts of rules, and the purpose of this, it's actually a good purpose. It's to protect us. It's to protect us from unscrupulous business owners who are selling shares and there's no disclosure in what's going on in their company. So there's all sorts of exemptions and people whom you can sell shares to without getting in trouble. Some of them might be your employees, your family members, and persons like that, and there's numerous others. And that's very common. That's why founders and business owners don't think twice about issuing shares to their brother or their first employer or their business partner. But you're actually only allowed to do stuff like that with certain language in your articles of incorporation, and it's there on purpose. And we could dive into that, but I'm sure the new online stuff hopefully accounts for that. But I know if you incorporate federally, those are the worst. The federal incorporations, unless there's a new program out there that I haven't seen yet, are just terrible. The ones operated through the government. They don't issue you shares. None of that stuff. It's just sort of asking for a mess. So on the next slide, Alina, I just want to, before we leave corporations, although we'll touch all around them on other topics, it's not just important to set up the company, but it's also how best to use it. And the incorporation is really the start of the journey. So I just want to emphasize that it really is important to contemplate how the company is going to function beyond inception. And since we're going to be covering these topics in some detail later on, I'll leave it at that, but just something to put in the back of our minds that owners need to consider.
Sorry, before we
Yes.
continue and move on to the other topics, there is a question regarding incorporation, and Jacinta has to go after an hour, and she's the one who's asked the question. She's asking, how much does it cost to get your company incorporated?
It's usually a bit of a conversation with that. It depends what your goals are, Jacinta, the short answer. I can almost guarantee you it's not as low as an owner, but it's not exorbitant. It depends on if you want multiple share classes or how much advice you want on how to structure it. But I'm happy to have a separate conversation with you, Jacinta, if that'd be helpful.
And how do I contact you?
Oh, I think my email, Alina, is my email address at the end of this presentation?
It is. Your contact information is there, and I'll also send it over to you via email.
Okay, thanks.
Thank you.
Okay, so I put employees and independent contractors on this presentation because, well, you're most often going to hire someone, whether you think of them as employees or contractors, and it's very important to have thought about what you're entering into. Because I'm not covering IP in depth, I'll sort of try and account for it here in one quick point. When you're dealing with contractors, who owns the intellectual property is a little bit different than dealing with employees. I just want to highlight that one to start off, because if you're in the tech space or you have any sort of ideas, employees, it's more than a rule of thumb. The inherent law is pretty much, you've hired them to do the job, everything they do is yours. That's not legal textbook, but that's the concept. What you do is for the company. That becomes a bit less clear with contractors. So I'd start with that one, because if you're going to deal with a contractor, I would say you definitely need an agreement at the outset, if for nothing else than to deal with a lot of clarity around intellectual property. If intellectual property is going to be a big part of your business, and you could stumble right out of the gate with that one. Because the worst thing you're going to do is going to want to circle back and have tougher language. Because what a serious investor is going to do when they come in, and it's an IP heavy business, they want to make sure it's all yours and there are no loose ends. And you might have a loose end off the cuff with some of these agreements. So it can, I don't want to say it can go south really quickly, but you might have missed a golden opportunity to prevent something worse from happening. So that's a bit of a tangent. So this, as I said, this is a major item, and I just want to set up the mechanics here, because from an employer's perspective or a company's perspective, and even from the individual, the contractor relationship has a lot of benefits for both parties. The employer, the company really likes it because it's simpler. There's no payroll. There's no source deductions, the remittances that get taken off your paychecks and remitted to the government. There's no questions about benefits or vacation leaves. And most importantly, you're not subject to the Employment Standards Act. So it makes your life simple, especially in those early stages. As for the other person, the contractor employee, depending on how they're classified at law, there's lots of benefits to be determined as a contractor. If you're a contractor, you're basically like your own sole proprietor, or maybe you're incorporated. So you're taking advantage of all the deducting meals, your gas. So it really works for both sides in a lot of cases. So it's easy to go down that road. And trust, businesses of all large, small, middle size, this question comes up all the time. So this isn't a startup thing. This is an everybody thing. But however, where it all comes to a head, because the question is, well, who cares? We call ourselves contractors and we're both really happy. But the relationship might break down at some point. And then that contractor is all too happy to enforce their employment rights, because there's a lot of things they didn't get. They didn't get vacation days. They didn't get overtime pay. They didn't get termination pay. So if they really are an employee, and we'll talk about what that might look like, everything's fine while everyone's getting along, but it's that moment of relationship breakdown where you get exposed. And we'll talk about that. And the other way you'll get exposed is to the CRA. I'm talking here like everyone's doing this, but it's not. You can fall into it inadvertently. But what you haven't done is you haven't made those source deductions. So not only do you have an employee termination pay issue going on, all these things you should have been deducting from paychecks you haven't been doing, and you should have been doing it. So you have a tax liability sort of looming over there. Okay, so now we'll talk about what are the things to look out for in deciding who is what and what determines that. And unfortunately, it's not a bright line test. It's a bit of world of gray, but there are a number of factors to consider. These are some of them. These are not all of them. Exclusive work is definitely one if someone's only working for one company. It's a bit of all this is part of a bit of a sniff test. The more control that the company is exercising over the worker, not only when to do it, but how to do it, the expectations, rules, and guidelines, that all weighs into the decision. Does the contractor come with their own equipment and tools, or are they basically showing up to a company provided desk and equipment? Also something to look into, and just how integrated the worker is into the employer's business. So those are some of the things. I think we all can spot the easy ones. Person comes to work every day just like you. They call themselves a contractor. You call yourself an employee. But it can get a little convoluted. So the best we can do is document it appropriately and proceed in some cases. So one of the common misconceptions, sorry, my screen just blacked out on me here. Oh, sorry, if you go to the next slide, Alina. So I just want to highlight some of the thinking behind the laws governing the employee and employment relationship, because it'll help you think things through as an employer might. And that's that the law has an underlying premise that there's an unequal bargaining power in this relationship. It's unbalanced. And this is why employment law seems to disproportionately favor employees, at least from a company perspective. And courts will say that outright in their decisions. And I actually agree with this. To a certain extent, because if you've ever been employed and you've tried to negotiate with your company, you may have felt quite intimidated. And this is because the company generally has the knowledge, the expertise, and the resources, presumably, and of course, the ability to terminate your employment. So for that reason, you have to be very careful as a company in your employment agreements, because the courts are looking for ways to see where you might have been offside, because they know it's really hard for an employee to, one, be knowledgeable of their rights, and then two, to call out the company. It's very hard to call out your employer. So that's a bit of the mindset. Another common misconception regarding employment laws is if you were to read the Employment Standards Act on its face value, you would think that is telling you everything you kind of need to know about how the relationship be governed. But really what the act is setting out is just the minimum standards. So for the employer to actually benefit from the minimum standards set out in the act, it has to be in an employment contract. Because you will read the act and it will state that if you wanted to terminate someone's employment, all you owe them is 1 week per year of service up to a maximum of 8 weeks. Maybe there's severance pay, but this tends to be for larger companies. But that's generally it. It doesn't sound too onerous. But the employer will only get that benefit in a carefully laid out employment contract. It doesn't have to be a complicated clause. The clause just has to be perfect, literally perfect. And that's because, as I said, the courts are looking for ways to punch holes in these contracts. Maybe the easiest one to wrap our heads around is probation. If you don't clearly set out the probation provision in your employment contract, there actually is no right to just terminate someone on 3 months. It's in the act, says you can, but you can't do it unless it's in the employment contract. You've actually just sort of stepped right into a lawsuit if someone really wanted to, and they'll get outsized compensation for only being there 2 months. They'll actually get a lot more than you think. So I wouldn't blame anybody for getting a little confused by thinking that's how it's done, just by reading the act. And if you go to the next slide, Alina. I mean, yeah, that's fine. Yeah, I mean, the comments about obligations between companies and their contractors is almost the exact opposite of everything I just said. They're viewed on a little more of an equal footing, but I will caution, the law you'd think that you could terminate a contractor and give them nothing. Trust me, I'm not a person that goes for all these concepts of just want to terminate everyone and give them nothing. But don't be fooled. Just because you don't have a relationship with the contractor and the relationship ends doesn't mean you owe them nothing because they're not your employee. It's a whole minefield out there, even in business to business, where if you could imagine one company is very reliant on another company, it could be relatively sophisticated companies, but even more so where a dependency relationship exists. And the company with the power after 5 years just says relationship's done next week. Very similar to employment concepts start to creep in to, wait, that's not good faith. That company actually should have given this much notice. That happens. So anyways, it just drives home the point that it is important to document either relationship and maybe give an oversized emphasis to the termination provisions and how the relationship ends. So some of the protections, just to highlight a few that employees will be entitled to. I don't think these are going to shock everyone, but they're just meant here to illustrate the types of concepts that exist for employees that will not exist for contractors. So if you're talking with a contractor and you're getting into this type of stuff in your agreement, that starts to look a little more like an employee, but we don't need to examine every one of these. If you go to the next slide, Elena. Thank you. So I just wanted to highlight quickly, because I think some of these are kind of fascinating, of important topics to consider. I touched on the probation one, so I gave myself away. I just think that one's neat because everyone thinks you have the right, but you actually don't unless it's in the contract. But just to show you how finicky termination clauses have to be, is there was this case called Waxdale a couple of years back, so quite recent, and it literally blew up. Hopefully, maybe there's a lot of employees on the line, but it literally blew up countless employment agreements in Ontario. And what I mean by that is, it is now a field day for employment litigators, for anyone who has signed an employment contract more than 2 years ago. And very briefly, in this case, and I'll describe it terribly in the grand scheme of things, but the important point will shine through, is the gentleman was terminated without cause and was paid notice, according to the Act. That's not the issue. The issue was there was a clause in the agreement that said the employee could be terminated with cause, and in such a case, the employee would be given nothing. Very common to have drafted agreements that way. Everyone understands just cause, you get nothing. The problem is there is no concept of just cause as set out in the Ontario Employment Standards Act. You can only terminate someone and give them nothing for misconduct, essentially of a serious nature that is not trivial. Something like that. That's not just cause. So the question is, well, the employee was terminated without cause. We're not even talking with cause. Who cares what the with cause provision says? And the court said, whoa, well, that's too bad. One part of your termination provision is unenforceable, wipes out the whole thing. So there's still going to be many employment contracts out there that just deal with just cause and say, we can terminate you for just cause and give you nothing. That's gone. That is out the window. That's a slam dunk for any. I'm not an employment litigator, by the way, but it's really something. It just shows you that it's interesting, and it's important to be careful with these things. I put layoffs on this list just because this is purely a COVID concept that now shows up everywhere. Never used to really think about layoffs unless maybe you're in the restaurant or construction industry, but you only have the right to lay off employees for most companies if it's actually in your contract. That's why the Ontario government actually changed the legislation during COVID to allow companies to lay off people, because it was literally hundreds of thousands of termination cases floating around because you don't have the right. I put vacation pay in there because there's one very interesting point about vacation pay that's becoming more prevalent, and that's vacation pay is payable on all wages. And it's what constitutes wages that's important. Not your traditional salaries or hourly wage, that one everyone gets, but commissions are wages, and non-discretionary bonuses are wages. So a truly discretionary bonus, and sorry, we get into the weeds, but I just find some of these examples are neat. A truly discretionary bonus has to be truly discretionary. It sounds silly, but most people have targets, and you hit target X, you get a bonus. Well, that's not really discretionary, even though your contract says it is. Well, that's a wage. So there are companies out there with employees that have been around for a very long time, and this is a company-wide problem, that have never paid vacation pay on bonuses that aren't really discretionary. And you can just see how this stacks up company-wide. Now you're at employee 10, 15, or you never did it, or you pay people by commissions. So just give a little bit of thought to how you pay people and how you want to account for that. Yeah, I think I spent enough time hammering through some of the fascinating things of employees, so we'll move on. Okay, yeah, here similar to above, I just highlighted some of the things, more for the sake of the slides, and hopefully that there'll be little reminders of clauses that you might want to raise or think about. I think I've talked about intellectual property and being very. One thing to say is be very clear on the services that are being provided and not be too loose, but most of this can be addressed with a few important thought and care and consideration. So if you don't mind just moving on to the next one, Elena, thank you. And I think I've really covered the depth, maybe perhaps the importance of documenting it. So we'll cruise through that slide as well. Okay, which brings us to our anti-spam laws. And they're relatively new. And Alina, I think you did mention this was a matter of people. Okay, I wasn't going to talk about this one, but we put it in here. It is pretty interesting. So what is the Canada's anti-spam legislation? Well, it is what it says on the slide there. It's there's a lot of regulation now about what sort of commercial messages companies can send to solicit customers for their services. It really focuses, its core is all about consent, express or implied consent. And I'll dive into that in what you can and can't do. And unfortunately, it'll lead us to a world of gray, but I'll try and give a roadmap of what's permissible. And express consent is obviously going to be a little easier than implied consent. So if our firm wants to send a newsletter, we now only do so if someone clicks the button. That's why you get asked to click in the newsletter button every time you're buying something online, something like that. That they're after express consent. They don't even want to guess. So that's by far the safest way. And we put here, yeah, it does not apply to one-way general broadcast of a commercial message on social media. It also doesn't apply to phone calls. That's why cold callers, unfortunately, are still out there. And if you go through the next slide, well, I'll get through some of these and then I'll give you a practical example of how this might all come about. So the slides are useful just in highlighting some of the key things that your commercial electronic message has to include. So if you have questions about this with the slides and sorry, so that question come up, but we can get into the details of exactly what the messages have to say, how quickly you have to respond to the unsubscribe features. And if you go to the next slide, even Alina, these slides hinted at it. We do have the penalties up there. I'm not saying ignore the absolute max penalty set out in legislation. That would be negligent. It's just that's the max. CASL has been enforced pretty heavily. There's been some pretty serious fines, but if you ever read the Business Corporations Act Ontario, there's some pretty heavy fines for not filing an annual resolution, and I'd say less than half of companies do. So take it with a grain of salt, but they are out there, they are enforced. What I really want to focus on or explain in CASL is if you're in this industry, how does your business function if your business is out there trying to solicit and find new customers? And we had a client coming up from the United States, and they said all our competitors are out there spamming everyone, and we're trying to figure out how do we even approach these people. It sounds like we can't even send them an email. So we dug into it, and excuse me, it's interesting. They're definitely going the implied consent route. And when you go that route, there's a few things to follow. And sorry, I'm going to pull up my notes a little bit. So you're allowed to contact someone under CASL where they have conspicuously published their email address. The website does not contain a statement that that person does not want to receive unsolicited commercial electronic messages. And then the key part is the message is relevant to the person's role, their business, and their functions and duties. Now, that's not what really interested us because that's sort of in the legislation itself. But that's the implied consent. The other huge factor of implied consent is if you have an existing business relationship. And we could go through that door, and there's more to it than that, but existing business relationship, there's going to be timelines, and when those expire, like, well, when is a customer 10 years ago no longer an existing business relationship? But more or less, if you have one, you are free to message that person as long as it probably reasonably connects to goods and services that they were interested in last time. But the implied consent is really tricky. So in this case, we could identify their customer targets, but they couldn't just pick any random person in the organization on who to solicit, or worse yet, spam everyone in the organization. The way to navigate it, and there's not enough cases to have a huge painted roadmap with tons of examples, but you really have to put some effort into figuring out the right person in that organization to contact. And if that person's email address is publicly available and does not prohibit the electronic message, that's your best bet. But when an IT provider contacts me, which they do all the time at my firm, and asks me how much of an effort did that person really put in, I sometimes feel like they just violate CASL. I'm not the IT guy, but it's that kind of mindset. That's also your best defense. So it's tough. Look, it's tough, but that is also you're building your defense by putting in the effort to try and figure out the right person to contact. And if you've done that and you're reasonably assured that you've done it, then that is the way forward. If it sounds complicated, it's not so much that it's complicated once you understand the basics. It's just figuring out that gray area of did we do enough to comply. But those are the Coles notes, honestly, what I found interesting about CASL. But the ramifications are serious in that respect. So if we could move on to the next slide. Thank you. Which brings us to a unanimous shareholders agreement. And essentially what these documents are is that they are an agreement among all shareholders, so just like the name sounds, that helps govern and address how the corporation is going to be managed. And a robust shareholders agreement is really going to cover a whole range of factors that span from how the corporation is funded, what are the restrictions on the ability to transfer shares beyond what maybe is set out in the articles of incorporation, and often how to, well, a good one should really contemplate what happens in the event of a shareholder breakdown. So it always contemplates an exit. Shareholder agreements do not have to be unanimous. If they're not, they're really just an agreement between two shareholders, and they can say whatever items they wish to address. But when I refer to shareholders agreements in these couple of slides, I'm always referring to a unanimous one, because a unanimous agreement has a much different legal connotation. It's right up there as with your articles of incorporation in terms of importance and how the corporate entity is going to be governed. That's how high up its authority is. So some of the benefits and why go to the expense of having one. And the quick answer is that it's far easier to negotiate these agreements when everyone's friendly, and it's absolutely impossible when there's already a rift. How can you? It's going to contemplate things like exiting, and if you're already fighting, you just can't. I've never really seen it successfully done. So it's going to set out restrictions on the right to transfer your shares. So as I said, most of the time your articles of incorporation are already going to address this, but the shareholders agreement is going to set out greater limitations. It might require the affirmative vote of one shareholder. So imagine you were the founder of the company, and even if you gave away 60% of the company, you still own by far more than anyone else, and you want the final say. The agreement can account for that. It could require that affirmative vote. So the most an obvious scenario might be three shareholders holding 40%, 30%, 30%. And the shareholders might want certainty that they don't want anyone transferring their shares without unanimous consent. So you might require 100% transfer voting shares. It's three friends, three business partners. They don't want anyone else in the mix. It's got to be unanimous. These agreements will absolutely account for that, or a good one will. Another thing it will account for is key decisions and who will be the directors. I would almost always say the agreement will account for this. So the board of directors manage the company at a higher level, and they appoint the officers to run the day-to-day. So the agreement will almost always dictate who might have voting rights to appoint people to the board, which is very important to have control of the board to affect decisions at the company level. A minority shareholder might, it'd just be wary depending on your perspective. If you're the majority shareholder, you don't want to be granting a 10% shareholder veto rights over anything you might otherwise be allowed to do. So I would just highlight that. But examples of what key decisions might require some sort of special approval, things like guaranteeing loans to third parties, so getting a bank loan, borrowing money from anybody or non-arm's length parties. You don't want the business maybe borrowing from your business partner's brother unless you're part of that decision. That would be a common one for a minority shareholder to get to weigh in on those non-arm's length transactions. You might want super majority rights for amending the articles of incorporation, or approving your annual operating budget, or repaying shareholder loans. So in a shareholders agreement, you can be as creative as you want and really tailor it to your situation. And without it, you're relying solely on the act on how things can be governed, which can be a little problematic. One of the biggest spots that I think early stage companies encounter is when there's a breakdown in the initial relationship. And we're often stuck in a scenario where certain people are left funding the company, but the shareholder who's checked out isn't contributing any funds. And then you're really in a tight spot, because a couple of clients like this right now, they really want the business to succeed. They're in contracts that literally require them to make lease payments, but the third shareholder just no longer active in the company, not cutting those checks. What do? There's nothing in the Business Corporations Act that says that person has to put in the money. And there's nothing that says if you put in the money, you automatically dilute them in their shares. What you're really doing is you're tossing more and more money into the company and maybe calling it a shareholder loan or something like that, but that doesn't really make you feel too great. So a shareholders agreement, without getting too into the weeds and how we might tackle that problem, can address those situations. It can describe out the mechanism for what happens when, first of all, who makes the decision that more money needs to get put in? And once that decision is made, what happens to the person who didn't put the money in? A shareholders agreement can account for that so you don't get stuck. Or it could have a clause that accounts for how do we exit this? We're simply not getting along. It should have one of those. So lastly, at least for as far as unanimous shareholders agreements are concerned, I'll view this from the perspective of a super majority shareholder, someone who owns over 50% or even higher. They're probably going to want a provision that allows them to drag along a shareholder if they want to sell the company. Because if you don't, just as I said previously, there's nothing in the Business Corporations Act that makes someone put in money. There's also nothing in there that makes them sell. So you could own 95% of a company. You could have given away 5% to your first employee and then just stop there. And now you're selling, but maybe you can not even find that person. Or maybe they just don't want to sell, or they want to use that as leverage against you. I've actually never seen the leverage 5% play out, but that could happen. And you're stuck because nothing makes them sell. But you can insert a clause in the shareholders agreement, which would be very common, that says, hey, if I own over 51%, two of us or whoever, how many together own 51%, we want to sell, we'll give you a notice and you're coming along for the ride. You'll be treated exact same as us. Everything's fair. But you now have the power, so you're not trapped. But without that, you literally are at the mercy of the minority shareholders. And I'll leave off on that example on this topic, because this bleeds into the employee stock options, which I wanted to talk about briefly. And thank you. Employee stock options, I thought I should include them because it's very common also to get approached with loose agreements, especially with contractors. Because money's tight in the beginning, and sometimes you're issuing shares to get the thing off the ground, or someone just wants a piece of the company. So step one in my head is always, well, let's make sure that you have a good shareholders agreement in place. So whenever that person gets those shares, they're already bound to this agreement. The agreement is contingent on them signing this shareholders agreement, which leads us to employee stock options. And I just want to talk about this topic to, one, maybe stop somebody from loosely sending out option agreements that say, oh, if you've been here for 6 months, you'll get X, or a year, without setting out the parameters. Because we want to be very certain, one, what type of shares are your employees going to get? Goes back almost to our first point, but they don't have to get the same shares as you. At the appropriate time, you might create a separate class of non-voting shares, completely identical in every other way, all the benefits, but these ones are non-voting. So they really are just passengers on for your company in most respects, not every, but it strips a lot of the inconvenience of having minority shareholders. You also want to give a lot of careful thought to the vesting period. When are these options going to kick in? Absolutely, I would say and you can only do this when you issue the options. The actual issuing of the shares, once someone exercises that, has to be contingent, or should be contingent, on them executing your shareholders agreement. You can do that. You might not even have to have the shareholders agreement draft pre-ready. This could be years in advance, right? You could issue options but you want to make sure that agreement is absolutely referencing an agreement that you're going to thrust in front of their face at the time they actually get the shares. You also want to account for scenarios like what happens if that employee's employment is terminated. Maybe they got terminated with cause. It will be a pretty big rub to have options out there that don't think about what happens in that situation. What if that person dies? What if they become disabled, terminated for cause, etc.? It's not a very long agreement. It's not creating a mountain out of a molehill. It's just your feelings and opinions on timelines for these options are greatly impacted, and it affects your corporate structure and your ability to raise money, and who wants to pour money into a company where there's all these employees terminated with cause, or people who did something God knows what, and it gets messy really fast if you're not thinking about what happens. You also want to think about related, but that the invested options expire after a certain time. They're not just out there lingering, they have an expiry date. And those dates are often triggered by maybe the date they're terminated, maybe the date that person is disabled, stuff like that. So I don't want to end it on a sour note, and I hope this was relevant to maybe some of the thoughts you have with your own companies, or maybe things you're thinking of doing in the future. I know we danced around a lot, covered a lot of ground, and there are some tangents in there. But if there's any questions about any of these items, or more clarity, and we skimmed through some of it pretty good, I'd be more than happy to answer any questions at this time.
Right, there are a couple of questions in the chat. I'm going to leave Alex's email address and contact information on the screen for everyone. Alex, let me just go through the chat. There were a couple of questions for you. I'm just scrolling up to see. Yes, so Gary's asking, what are trusts as companies?
What are trusts as companies?
Yes.
Well, I'm not sure if maybe referring to trust companies or just the concept of trusts. I'll tackle trust because that's what I deal with a lot, and I think that's maybe what we're probably getting at, rather than trust companies, which are, I'll give you a terrible answer, but nothing that would concern us in this subject matter. But sometimes people create a trust, and they're often a family trust, and it's a method of how to own assets. It's a different method. So under tax, it's extremely prevalent for tax planning. You can do it for disabled children purposes, and you can do it for lifetime capital gains exemption splitting are the two examples I deal with the most. Estate planning for one, for dealing with children with disability, it pops up a lot, or dealing with certain assets, and it comes up a lot with business ownership. So I'll just talk, it's a huge topic, but I'll cover one element that comes up. It's almost like the cheat code for splitting your lifetime capital gains exemption. So say instead of, this won't tell you the full story, but say instead of you owning the shares and they're worth $1, or let's just say they're worth $100,000 right now, you decided to transfer those shares to your family trust. Now your family trust owns the shares, and you took back a different type of share class that'll never be worth more than $100,000. And the company goes to the moon. It goes to 5 million. Really making this up. I hope you all achieve that level of success. Hope I do too. You can now split that capital gains exemption, assuming you satisfy other criteria of the test. But if it's a normal operating business, let's just assume it is. Now you have 4. You, your wife, your kids, 4 million tax-free. That's most often how we see it done, and the purpose. I will say it for early stage companies, because I do have some early stage clients that a couple years into existence, they're getting a lot of traction. And they start realizing, hey, I think we're actually gonna do really well. And I'd shoot you over to a tax accountant in a minute to put this together. As in, we wouldn't advise on the tax side, but it's very common to say, well, okay, wow, the business escalated in value really quickly. Do you want to gamble on yourself a little bit and move the ownership into a family trust? Because you got a young family and a wife, and you could put your dad, your brother, you don't want to go crazy with it, but it lets you do that because they think they're going to hit a home run in 5 years or 20 years. It doesn't matter when. That's when trusts come up. How trusts are governed. Sorry, I didn't address that. No one owns the trust. There's trustees of your trust. Just like when someone dies, there's a trustee of the estate. They're doing the same function. They're administering the assets. So you might think you're losing, doesn't sound that appealing now anymore. So I go from owning it to my family trust. Well, you can be a beneficiary of your own trust. And you don't have to split it evenly. You could do it all to you. So if the company made $5 million, you might have listed 20 people as beneficiaries of your trust, but you're the sole trustee and you are permitted to transfer all the assets out to you. We could go down this rabbit hole for a while, and it's hard to say it without graphically seeing it because it makes a lot more sense. But that's how I see trust companies used a lot. As to what they are, that's probably a terrible answer, but that's a cool thing they could do.
Got it. Thank you so much for that, Alex. Sue has a question. Are there any issues with incorporation and only one shareholder?
Absolutely none. They're the easiest and simplest of the bunch. And a lot of the concerns about liabilities and things like that, I would try to go by the wayside and shareholders agreements and all that. So nothing wrong with it. It's a very attractive thing to do for liability protection, if nothing else.
Perfect. There was another question. Sorry, I stopped sharing the screen and I've lost my chat. Yeah, Ian is asking, did any big court cases come from the Castle ruling? It's been active for 5+ years, I believe, but wasn't sure if the laws were ever enforced very hard.
I'm not sure about massive cases, although I think the slides did list 3 or 4 cases that resulted in pretty serious penalties. And for that client I referenced, there have been serious ones. I mean, long story short, yes, but yeah, it is still pretty new. And I don't think there's been a case that's bankrupted any company, but they're certainly getting punishments are being handed out. I wouldn't take it. We don't take it lightly. I wouldn't take it lightly.
Got it. Delavez is saying my internet was lagging, but can you repeat what you said about business license in Ontario?
Oh, sure. I'm trying to think of one aspect of the business license. I was just trying to illustrate that there's not a lot of difference between incorporating in Ontario or federally, other than if you don't have any resident directors or resident Canadian directors, then 100% do Ontario because it doesn't have a residency requirement at all.
Great, thank you. You can feel free to also raise your hand or unmute yourself and ask your questions. Alex, while the attendees think of a question, I have a question for you, and this was actually presented to me from one of the founders that we're working very closely with. She wanted to know what is the right time to incorporate if she's just starting out, she just has 3 to 5 customers and all her clients are outside of Canada, whether she should even incorporate or not.
Tricky without knowing all the circumstances, but it comes up every time. So it is a great question. It's the question almost. There's 2 key reasons why you'd incorporate. Like I said before, it's a liability protection. What sort of business are you in? What's your exposure? What's your worry? Your risk tolerance at that level? And then the other is ultimately going to be for tax purposes. When are you getting to the point where you really want to benefit, or there is some benefit to the taxation that the corporate rates take advantage of, which is a little bit of a talk with your accountant. It's also one thing I didn't mention in the slide deck is it can become more complicated to ultimately transition into a corporation or convert your sole proprietorship into a corporate entity. It's all industry specific, but if you think about if you have recurring customer contracts or a customer contract with a long term, let's say a couple of years, and then you want to incorporate, well, you have a contract that exists at the sole proprietor level with your customer. You're not going to go back to your customer and say, oh, let's just scratch out this name and put in this name. So it depends on what you're doing and what your contracts look like. So the sooner the better if you think you're going to get traction and it's ultimately something that is going to make sense for what you ultimately want to do.
Perfect. Thank you. Shanze is asking, would incorporating provincially or federally have an effect on the business operations?
None that crossed my path. I mean, I'm sure there's differences, but in my eight or 9 years, I never really come across one that's mattered. Dealing with privately owned companies with, handful of shareholders, most common, I've never seen it affect something.
All right, great. Any more questions?
Hello, hi. I've got a question, if that's okay,
Yes, of
to
course.
Alex. Alex, my name is Piaz. I own a corporation and it's been in business for the past 2 years. And where I've kind of mostly struggled is like I would like to know, I mean, it's quite business specific or industry specific question, but I would like to know what would be like, how would I know what are my regulatory requirements for the industry that I'm in? So just to give you a little bit of heads up, we are into manufacturing and retailing kids furniture. So there is a little bit of a liability factor that is not little, like actually quite a bit of a liability in there, which, we protected ourselves as much as we could legally as well as from an insurance point of view. But how would I know my what are my obligations to the federal government, or what are my obligations to the specific industry that I'm in, and how do I know what kind of packaging information, branding information, product, what I have to display, like those kind of information. Like, I know it's a little bit taking the conversation away from the main topic, but this is something that I was very curious to see if I could ask you that question and to see where you would guide us to in this case.
It's a great question. It's confusing out there. Answer this question would be to a regulatory lawyer. It's better than that, but because I've had we have all sorts of customers. We're industry agnostic, so we get questions out of left field, and that's very common. I know enough to know that kids furniture, you're automatically in a world of a highly regulatory environment. Most other products and services, that's not going to come up in the same way. But kids product and stuff, so I could see why you're asking that question. I can only say for this from experience is this won't sound great, but I guess I kind of know where to look in the government regulatory website in what to search. I'd be happy to follow up with you and give you a couple names. I just know the industry you're in, you're going to want an ironclad answer and certainty on that. And you're going to have to see someone who really sort of specializes in the regulatory world. And there's firms out there who do.
All right, perfect. So, Alex, I'll go ahead and send you an email after this conversation and drop you a note. So if you can carry on the conversation, out of this session. There's one more question I was curious about. It's about patents and how does patents work. If we have a patent in Europe, is it valid does it apply to Canada, or if vice versa, and also to the United States? And so, if you could just briefly explain, how does a patent work? Like, if I file it in Canada, is it valid in Europe, and is it valid in the US, or it has to be filed in all three different entities, which is the EU, US, and Canada?
Yeah, another great question. I'm sorry. I honestly, IP is again one of those where we stay in our lane because it gets so specialized in working with founders that we work in conjunction with other Y-space experts in the IP field. So I don't want to mislead anyone on that field. I want to guess. Okay. I want to say what I think, but I don't even want to get that on recording.
Thanks for your effort, and I'll drop you a note about my previous question, so we can take the conversation offline.
Okay, thank you.
Great, amazing. Thank you for that, Alex, and thank you for your question, Fiaz. So Shanse has another question, and that she's just building on what I had asked earlier. She's asking, how big would you need to grow before incorporating being worth the effort?
That's a tough one. I mean, I'll answer it with the dollars and cents to put it in perspective. I can't duck Jacinta's question any longer. You asked how much it would cost to, because it's all going to be how much is incorporated, and if it all falls apart, how do I get out of it? So let's just say you went with owner. I think they're $500. I think to incorporate through a lawyer, you're probably looking around double that ballpark for probably something similar, but more tailored advice and answering questions and all that stuff. So you're in for that. You're in for, I don't know if owner includes fees, but then every year you have to do tax returns for your corporation. So there's an additional expense. And then if you really want to wind up everything because it just didn't work out, depends how far down the road you are on that. But dissolution could be filing articles of dissolution, just like similar-ish concept, just the other way with the articles of incorporation. Great, the more complicated your company is, you can only dissolve if you have no assets and liabilities. But if that's an easy thing to answer, dissolving is really no problem too. So if you want to look at it that way and then take what I said about measuring your risk and belief. So it's not an inexpensive exercise. I don't want to dump that down, but it's not an impossible thing to unravel once you've got going. And you can do so relatively affordably early on. And later on too. It's just more administrative work, I would seriously say, on your part to do those steps.
All right, great. And what resources would you recommend to further explore these concepts and feasibility?
I'm sure there's a lot of great online content out there. I mean, we do have links at the end of this website. I think you'll find most firms will have some pretty good snippets here and there. So start with ours, but where it's not unique, getting the lay of the land about stuff like this. So we've enclosed our Doing Business in Ontario one. I think that's a good one to sort of jump around on the various topics and figure it out. But I don't think any of these are really going to answer when's the right time, other than just being aware of money it takes to do it, money it takes to get out of it, and feeling comfortable that you're at a stage that you really want to do that, spend that money and give it a go.
All right. Okay, any more questions? All right, Rebecca has a question. A business account also incurs banking fees and in my experience have lots of limit. Does anyone have suggestions of a bank or credit union with startup friendly accounts or offerings? That's actually a really great question, Rebecca. And I think she's asking, Alex, do you have any recommendations?
No, I'm sorry. Not when it comes to friendly accounts or offerings. No, I can't say one's better than the other. I'm sorry. That's a gap in my knowledge for service offerings.
Yeah, Rebecca, maybe I can do some homework and see if I can find something for you. If I do, I'll get in touch with you and share what I've found. All right, any other questions? Oh, wow. So Edward's saying BMO has a startup business account with 0 annual fee. That's great.
Oh, good to know.
Yeah. That's what I love about the community, right?
I was hoping someone would answer that. Okay.
All right, great. So Rebecca, seems like you're getting some suggestions in the chat, so that's amazing. All right, do you guys have any more questions for Alex? Well, Alex, you shared so many different topics. I'm sure they're all pondering over all the different concepts that we've covered today. Oh, that's a very interesting one, Alex. So there's a question for you. How did you get started in this field?
Oh, boring answer. I have a finance background, always been interested in business, and I'd say more why I like the firm I'm at, and I'd say I'm at the firm I'm at because it enables me to talk to business owners in that community. So I find that part fascinating. The actual whys of what led me to law in the first place is the boring part, but I like the size of firm we're at because we deal with the whole spectrum. We deal with small, mid-sized, some larger. But what I really enjoy are the commonalities across the three. It's sort of shocking that the questions from starting up to the questions of the well-established, they're all in the same realm. In surprising ways, there's always going to be differences and different concerns at different stages, but I'd say there's more similarities than differences among the average client, no matter where they fall in the small or big spectrum.
Interesting, interesting. All right. I guess we're all caught up with all the questions. Well, Alex, thank you so much for this wonderful presentation. The knowledge, the information that you imparted today is extremely valuable, and I'm sure everybody, all the attendees, will find it extremely beneficial as well. So thank you so much. Before I let you go, I just want to share what we have in store for you next week. I hope you're able to see my screen. All right, yeah. So next week, same time on Tuesday, February 14th, we're going to cover the topic of Finance 101, another great session in which we'll provide an understanding of financial frameworks like cash flow, balance sheet, budgeting, basically all your financial modeling to project business runaway. Right. I would also request you to please fill out the feedback form that I've put into our chat. I'm just going to do that again here. Here you go. And with that, we come to an end to this session. Alex, once again, on behalf of the Markham Small Business Center and WiseSpace, thank you so much for sharing all your insights and resources with us. I really, really appreciate the time and effort you put into this workshop. So thank you so much.
Well, my pleasure. Thanks so much for having me, and thank you everybody for staying to the end.
Yes, thank you so much to all our wonderful attendees for joining us, for all your questions and the conversation and the engagement that we had today. I hope to see everyone next Tuesday